Hey everyone, welcome back to Corporate Decoder. Are you ready to unravel a financial report that's about as exciting as watching paint dry? Just kidding, we actually found some interesting details in this one. Stick around to find out more. Before we dive in, if you're into getting the real story behind corporate documents, hit that subscribe button. Also, join our Discord community through the link in the description below for even more insights. Today, we're cracking open the Eagle Energy Infrastructure Fund's annual report for the year ending in April 2025. Eagle Energy invests in energy infrastructure assets, which is another way of saying they put their money into things that move and store energy like pipelines. The goal is to get good long-term returns while avoiding complicated tax stuff. So how did they do? Let's get straight to the dollars and cents. If you had $10,000 invested in Class A shares, your cost, meaning expenses, would have been about $186. That's about 1.65% of your investment. For Class C shares, it would have been about $2069, which is about 240%. These costs cover things like managing the fund and other expenses. Now, for the big question, how did the fund perform? Well, Class A shares jumped up by about 25% during the reporting period. That's pretty good. The fund did well because the demand for natural gas and electricity increased, partially due to demands for electricity from data centers. When demand goes up, well-managed companies should increase profits. It wasn't all smooth sailing though. The report mentions President Trump announcing tariffs in April 2025, which caused a temporary market dip for energy. For those who don't know, tariffs are taxes on imported goods, but the market recovered quickly when the tariffs were paused. Basically, the market got scared but then calmed down. Let's take a look at how consistent the fund has been looking back 10 years. If you invested $10,000 back in September 2012, you'd have almost $20,000 by April 2025 before expenses. You can also see in the table how this fund stacks up next to the Alerian MLP Index Trust and the S&P 500 Index, two common ways to gauge the performance of a fund or investment against the overall markets. To make it easier to compare, we can also see the fund's average yearly returns. Class A, shares without load, without sales charge, earned about 25% over the last 5 years and about 3.8% over the last 10 years. Keep in mind, a load is another word for a sales charge, which is money you pay when buying or selling shares. Remember, the fund's returns don't predict the future. Digging into the numbers, the fund had net assets totaling almost $227 million. Altogether, investors paid about $1.5 million in fees to the advisory team to manage the fund. Advisory fee is just a fancy word for money paid to the money managers. Synod also looks portfolio turnover was around 32% over the year. Portfolio turnover was around 32% over the year. Portfolio turnover refers to how frequently the fund is buying and selling investments. High turnover can mean higher costs. Where did the fund put its money? Well, nearly 95% of the fund's money was put into energy assets. This includes things like pipeline natural gas, petroleum, and liquids infrastructure, which are then weighted based on net asset value. There were also smaller positions, including money market funds and utilities. As a snapshot of where the money went, the biggest holdings include companies like Targa Resources, Plains GP Holdings, and Energy Transfer. What this means is that the fund is betting on these particular energy companies doing well. In terms of big picture strategy, the annual report shares that no major shuffles have happened in the last year. Switching gears, let's talk about the auditors and what the Northern Lights Fund Trust paid them. The fees included nearly $30 for auditing the company's finances. You can think of it as a checkup to make sure everything looks okay. Then there was about another 11 grand for tax work, such as filing the company's income tax return. The fund's board says that Mark Gersten, Anthony Hurtle, and Mark Taylor are the designated financial experts on the audit committee. These guys are like the financial watchdogs, making sure the numbers add up and everything's above board. Before we wrap, both the main executive and the lead financial officer essentially said that the fund's checks and balances are solid, so they have comfort that the process of releasing information to stakeholders and regulatory bodies like the SEC is good. Now, for my take, Eagle Energy seems to have had a solid year, riding the wave of increased energy demand. But there are also some things to keep in mind. This fund is deep into the energy sector, which can be really volatile, so it will rise and fall with changing demand. A large stake in Kinder Morgan, for example, is betting on long-term prospects. The fund is not diversified, so if energy does poorly, most of your investments will drop. Another factor to note is changing US politics. The report already mentioned surprise issues and impacts from the Trump administration, and who knows what that or future presidential administration might do. I think overall there's opportunity, but any investment here has real risk. Alright, that's our deep dive into Eagle Energy Infrastructure Fund's annual report. What do you think about their prospects and what should potential investors make of it? Let's discuss in the comments. If you found this breakdown helpful, give us a like and subscribe for more financial file investigations. And especially make sure you join our Discord channel. Thanks for watching, and I'll catch you in the next one.